Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a roller coaster of satire, sarcasm, and, dare I say, sizzling economic truth bombs. I'm your host, the one, the only, the self-proclaimed, Wolf of Wall Street's smarter cousin, here to break down the latest economic drama with a side of shade and a sprinkle of stats. Buckle up, because today, we're diving headfirst into the European Central Bank's latest soap opera, starring inflation, interest rates, and a cameo by none other than Donald Tariff Man Trump. Oh, and spoiler alert, it's a mess. Let's roll the tape. Alright, folks, picture this, it's July 2025, and the European Central Bank, aka the ECB, aka the folks who decide whether your mortgage payments make you cry into your croissants or not, is in full-blown wait-and-see mode. Inflation's chilling at a cool 2%, the economy's shrugging off trade turbulence like a champ, and yet, some ECB policymakers are out here screaming, cut those rates. Cut 'em now. Meanwhile, the rest of the crew is like, why? Things are fine, Karen. And let me tell you, this internal ECB drama is giving Real Housewives vibes, but with less champagne and more spreadsheets. So, what's really going on here? Let's peel back the layers of this economic onion. Warning, it might make you cry, but not for the reasons you think. First up, let's talk inflation, baby. The ECB's got inflation sitting pretty at 2%, their holy grail, their North Star, their "we did it, Joe" moment. For the uninitiated, 2% inflation is like the Goldilocks of economics, not too hot, not too cold, just right. But here's the kicker, some ECB policymakers are acting like 2% is a crisis. A crisis, I tell you. They're out here pushing for another interest rate cut, even though the ECB's already slashed rates 8 times since June 2024. 8. That's more sequels than the Fast and Furious franchise, and let me tell you, the plot's getting just as convoluted. Now, for my finance nerds in the audience, and I know you're out there, clutching your Bloomberg terminals like security blankets, let's get into the nitty-gritty. Inflation at 2% means price stability, which is the ECB's whole raison d'etre. But here's the tea, some ECB doves, those are the folks who love low rates like I love a good espresso, are worried that the euro's been flexing too hard. That's right, the euro's up more than 13% against the dollar in 2025, making European exports pricier and potentially dragging down inflation in the future. And if inflation dips too low, we're talking deflationary nightmares, think Japan in the 90s, but with more baguettes and fewer anime conventions. But hold up. ECB Executive Board member Isabel Schnabel, aka the voice of reason in this clown car, is like, chill, y'all. The economy's resilient, and the bar for another rate cut is very high. And she's got a point. According to the latest Eurostat data, the Eurozone's GDP grew by 1.8% in Q2 2025, beating expectations of 1.5%. Unemployment's at a historic low of 6.2%, and consumer confidence is ticking up, per the European Commission's July 2025 report. So why are some ECB folks acting like the sky is falling? Spoiler alert, it's not about the data, it's about politics and power. More on that later, but first, let's talk about the elephant in the room, or should I say, the tariff-happy elephant across the Atlantic. Ah, yes, the United States of Tariffs, starring Donald Trump, the man who never met a trade deal he didn't want to blow up. As we speak, the ECB is sweating bullets over Trump's latest deadline, August 1, 2025, for the European Union to strike a trade agreement. If no deal is reached, we're looking at a potential 15% tariff levy on EU goods, which could cost the Eurozone economy a cool €180 billion annually, according to a July 2025 study by the Bruegel think tank. That's not pocket change, folks, that's enough to buy every European citizen a lifetime supply of Nutella, and then some. Now, let's connect the dots. Higher tariffs mean pricier European exports, which means less demand, which means slower growth, which means, yep, you guessed it, downward pressure on inflation. And if inflation dips below that sacred 2% mark, the ECB doves might just get their wish for another rate cut. But here's the twist, ECB President Christine Lagarde is out here playing 4D chess, saying, we're in a good place now to hold and watch how these risks develop. Translation. She's not about to panic cut rates just because Trump's throwing a tariff tantrum. And honestly, I respect the hustle. Why? Because the EU's not exactly defenseless, diplomats are reportedly making progress toward a deal, and the EU's already prepped countermeasures, like slapping tariffs on American bourbon and Harley-Davidsons. Take that, tariff man. But let's not kid ourselves, geopolitical uncertainty is the ECB's kryptonite. According to the latest geopolitical risk index from the Federal Reserve Bank of New York, uncertainty in July 2025 is at its highest level since the 2022 Ukraine crisis. And Lagarde herself admitted that higher actual and expected tariffs, the stronger euro, and persistent geopolitical uncertainty are making firms more hesitant to invest. Translation. Businesses are sitting on their cash like dragons hoarding gold, and that's bad news for growth. But here's the million-euro question. Is this uncertainty a good enough reason to cut rates, or is it just an excuse for ECB doves to push their low-rate agenda? Smells like politics to me. Alright, folks, it's time for the main event, the ECB's internal cage match between the doves and the hawks. In one corner, we've got the doves, those rate cut-loving, easy money enthusiasts who think low rates are the answer to everything, from a stubbed toe to a trade war. In the other corner, we've got the hawks, those inflation-fearing, tight money warriors who think cutting rates now is like handing a sugar-high toddler a Red Bull. And let me tell you, this fight is getting ugly. According to sources spilling the tea to Bloomberg, the doves are facing an uphill battle. After 8 rate cuts since June 2024, the ECB's deposit rate is already at a measly 2%, and the baseline for September 2025 is a hold. That's right, folks, no more rate cut candy for you. And get this, some ECB insiders are saying the onus is on the doves to justify why we need more cuts, not on the hawks to justify holding steady. Talk about a plot twist. But here's where it gets juicy, markets are listening, and they're not buying the dove's sob story. After Lagarde's wait-and-see comments, traders slashed their bets on a September 2025 rate cut from 40% to 25%, and the euro ticked up 0.1% against the dollar. Ouch, doves, that's gotta sting. Now, for my finance pros out there, let's talk expectations. A Bloomberg survey from early July 2025 found that a majority of economists predict one final rate cut to 1.75% in September. But here's the catch, traders are only pricing in 18 basis points of easing for the rest of 2025, down from 23 before the ECB's latest meeting. Translation. The market's calling the doves bluff, and Lagarde's not blinking. And honestly, why should she? With inflation at target, growth holding steady, and unemployment low, the ECB's got no reason to hit the panic button, unless, of course, Trump's tariffs blow up the whole game. But even then, is a rate cut really the answer, or is it just a band-aid on a bullet wound? Alright, folks, we've peeled back the layers, and now it's time for the big reveal. This whole ECB drama isn't just about inflation or tariffs or interest rates, it's about power. That's right, the doves and hawks aren't fighting over data, they're fighting over who gets to steer the ship. The doves want to keep rates low to juice up growth, even if it risks overheating the economy down the road. The hawks want to hold steady, even if it means pissing off politicians who want cheap money to fund their pet projects. And Lagarde? She's the ringmaster, trying to keep this circus from imploding while Trump's out here throwing tariff-shaped Molotov cocktails. But here's the real kicker, folks, this isn't just an ECB problem, it's a global problem. Central banks everywhere, from the Fed to the Bank of Japan, are grappling with the same question: how do you balance growth, inflation, and geopolitical chaos in a world that's gone completely bonkers? And for us regular folks, whether you're a small business owner, a homeowner, or just someone trying to afford groceries, this drama matters. Because if the ECB gets it wrong, we're the ones who pay the price, either through higher borrowing costs or runaway inflation. So, stay woke, my friends, and keep watching Boss Economics World, because we'll be here to call out the nonsense, one sarcastic quip at a time. That's all for today, folks. Don't forget to like, subscribe, and ring that bell for more economic truth bombs. And remember, in the world of economics, the only thing more inflated than the data is the egos. See you next time on Boss Economics World. Stay bossy, stay savvy, and stay skeptical.